Edward Yardeni, president of Yardeni Research, is joining in. Mr. Yardeni, so great to speak with you here on NDTV Profit and have you on.
Thank you.
The show, and obviously at a time which was very euphoric and heady from an Indian market perspective. But let me come to you on what we're seeing globally, and let's start with US markets and the concerns that things are getting too frothy for comfort.
Well, I think what we're seeing is a global liquidity flood coming from the major central banks. Other central banks started lowering interest rates before the Fed, but when the Fed went down by 50 basis points, I think it signaled the all clear signs for other central banks to be lowering interest rates. So the Chinese followed up with a whole slew of liquidity providing facilities and monetary policy. And so this is all driving stock markets higher. And I think there is a potential, we're not there yet, but where there's a potential for a melt-up scenario on a global basis.
Mr. Yardeni, good evening to you. And reading some of your research that comes in as Yardeni Quick Takes is quite really good. One of the things that stood out for me, which apparently you mentioned about 2 or 3 days back in an article, that there might be a possibility of a melt up. Now tell us the reasons for the same. Is it liquidity driven or otherwise? Part one. And how strong can this melt up be? And could it have an impact on markets like India as well? Because that's what our viewers would want to know.
Absolutely. I think that what we are seeing is the shades of the 1990s. And if this is going to turn out to be like the 1990s, the question is, where are we in terms of the decade? Well, I don't think we're in 1995. I think we're more like 1999, especially in the United States. When you look at valuation multiples, the S&P 500 is trading around 22 times forward earnings. And back during the tech bubble of the 1999-2000, we got up to 25. So we're already seeing valuation multiples that are already quite elevated, and we're seeing the same thing in India as a result of the perception that it's a great economy that's got a lot of potential for more earnings and growth.
So Yardeni, hi, it's also Samina joining in. You know, you're very fondly known as a soothsayer amongst all the bullish predictors on Wall Street. I did read up an article, or of course a conversation that you had, and you said one of the other worries is elections, which participants are ignoring for now. The fact remains that no matter which candidate comes in, measures will be inflationary. This will impact the deficit of the US as well. How real and big is this concern?
Well, I think that is the big risk for a bullish outlook. I think much will depend on whether gridlock wins. Gridlock being kind of a checks and balances system where whoever winds up being in the White House is offset by at least the House or the Senate being majority held by the other party. I think most of the political analysts I follow suggest that that's what will be the outcome, but we can always get surprised. And if we get surprised by a sweep by the Democrats winning it all or the Republicans winning it all, then I think we have to reassess the bullish outlook. But for now, I think we're okay until the November elections, and then we'll have to look at it one more time.
Yardeni, you know, I think you mentioned this and you said India is going through a massive boom. It's what China was doing in the 2000s. What we also remember is while China's economy grew significantly, its markets didn't really do the sort of magic that they had done on anticipation of the economy growing. With everything that's happening in the world, with China pushing big on measures, trying to fix the property crisis, historically we've also seen other countries take 7 to 8 years to fix property crisis. Where is the bias? Are you still buying an expensive India, or are you buying an aggressive central bank of China that's going to do everything it takes to pick that market up?
Well, I think they are trying to obviously turn things around, but I think it's going to be very difficult. As you said, property bubbles, when they burst, can take several years to turn around, no matter what stimulus is provided. The reality is that they still have much too many properties overhanging their market. I don't think we're going to see much of an improvement in property values. I think the stock market clearly has had a nice real rally here, but I still think that China has some real serious challenges with demographics. Obviously, India doesn't have that problem. India has a much younger population, whereas China exacerbated its problems with the one-child policy. Then now they're paying the price for that. And then, of course, it's still an authoritarian government. It's not a democracy like India, and they do change the rules, and they make doing business there very difficult. So I'm not convinced that these measures that they're taking are going to have immediate or even medium-term consequences on the positive side. I think India, to me, still looks better than China.
But let's drill down on that a little more, Mr. Yardeni. India looks better
Sure.
than China, and of course, you've given the basic demographic reasons, etc. But from an India perspective, when there's talk about the speed with which the markets have grown, valuations, how do you look at that conversation?
Well, valuation is stretched in the United States. It's stretched in India. So we could at some point have some sort of correction. I don't think we're going to, even if we have a melt up here where valuation multiples go even higher, I think we're more likely to have a correction maybe early next year rather than an outright bear market. Because I think the fundamentals for our two countries are still very strong, especially compared to the rest of the world. Europe is still struggling. Brazil may get some lift from an improvement in China, but I'm not saying that commodity markets are necessarily voting positively for what the Chinese just did. We saw oil prices, for example, weaken here. If the oil market believed that China's stimulus was going to work, you would see oil prices going higher. I know copper's gone up somewhat, but that too has not exactly been rip-roaring to the upside. So all in all, I think that they may have put in a bottom in their stock market. They may be providing some lift to their economy, but they're still facing some major structural problems with their property market. I don't think that's going to turn around. And I think in addition to that, they have a consumer that looks as though they're not going to be doing the kind of spending that the government hopes they would. And meanwhile, the rest of the world is complaining about China dumping goods in global markets. So, it's conceivable that the next administration, whether it's Harris or Trump, will impose some even more severe tariffs on China.
I just have one slightly very basic question from you, Mr. Yardeni. Why a melt up? Melt up versus a meltdown? I have to understand the thinking behind that term that you have been using, you've kind of coined. So tell us, why not just say meltdown? Why a melt up?
Well, I think a melt up scenario implies that at some point it could turn into a meltdown. The analogy would be what happened in the second half of the 1990s when we saw a melt up. A melt up is really defined as the market going up mostly on valuation multiple rather than on earnings. I do think that the earnings outlook is actually pretty good in the US. I think it's pretty good in India, but the enthusiasm we've seen and the kind of money pouring in, especially now with central banks lowering interest rates, can continue to lift the valuation multiple. And it's kind of like air. The more air you put into these stock markets, the less cushion you have, the lower the meltdown possibility might be in the event that something goes wrong. And I think that one of the things that bothers me about what the Fed just did is they basically made a commitment to lower interest rates several times in front of a political election where we could have a scenario where we have a sweep by either the Democrats or the Republicans. in which case I and others would be more concerned about inflation and the Fed having to pivot again to tighter monetary policy.
Very quickly, one last question. How do you feel about
Yeah.
metals and commodities right now? And I'm going to break it down between industrial commodities, gold and silver, and crude as well. The reason I ask this is because LME inventory is at a record low. The Fed's moved on the rate cut. China is doing whatever it takes, but demand still hasn't picked up, and that's the fact. Would you buy into metal stocks in India, outside India? I'll let you decide.
Well, look, let's think about copper, for example. Despite what the Chinese central bank and regulatory authorities did to stimulate the economy, they're not suddenly going to go from a property recession to a property boom. In other words, they're not going to suddenly be ordering a lot more copper for plumbing to build apartments. And so I don't think that with this stimulus that's going to suddenly lead to a much better, stronger economy in China. And meanwhile, whatever economic growth there is in China is coming from manufacturing for export to the rest of the world. So in that kind of scenario, I think a commodity like copper doesn't really have a lot of upside. The price of oil doesn't have a lot of upside because there is so much oil around, and supply side, and the demand side is weak because Europe is weak, and China may not get that much of a lift from what's going on here. But gold looks like it's going to continue to move higher because I think people are very nervous about the geopolitical situation being very unstable, and there's a concern that the central banks may now go the other way and ease too much and only have to pivot once again when suddenly inflation starts to heat up again.